Hello, good morning. This is Joerg Hoffmann. I'm the head of IR at Wacker Chemie. We reported our full year 2023 results yesterday and provided guidance on the first quarter. I'd like to walk you through the presentation on the full year results. I enjoy these presentations, but I'd also like to say that should you have any questions, you find our contact details at the end of the presentation, so don't hesitate to call us if you have any questions. Let's get started. So we reported on the full year 23 after we reported our prelims at the end of February. Not much of a change in the results for 23. What you see here, we ended up last year with 6.4 billion euros in sales, actually 22% down versus the record year of 22, with an EBITDA of 824 million euros in 2022. As a reminder, we actually achieved over 2 billion. We paid out 12 euros dividend last year. And despite this 12 euro dividend payment and per share payment amounted to about 600 million euros and over 700 million euros in capex, we ended the year with a relatively small net debt. Actually, our gross cash flow was bigger than our reported EBITDA. So what were the things that, which is something that you're going to hear again and again as we go through seconds, what were the things that defined 23? A lack of demand. We continue to have experience headwinds in all those segments. So we focused on costs and we kept our investments high. I think with over 10% of sales in capex, that's pretty strong for the chemical industry. We made very good progress on sustainability. We got top ratings for climate. The CDP, SBTi confirmed our net zero targets for 24. So we're actually leading the industry on sustainability issues. Let's move on. So let's go into the group guidance. We reported our full year results already as a preliminary, so the focus of this call was really on the outlook. So we're expecting 6 to 6.5 billion euros in sales with an EBITDA of 600 to 800 million, which is actually lower than what we anticipated last year. Main reason for this is lower exit rates at the end of 23 and the assumption of continued headwinds. This assumption does not bake into it any uptick in economic activity. It basically says the economic conditions stay unchanged. So this is the base on the assumption. Nevertheless, capex stays at close to 700 million. And because we stay on track for our targets for 2030, it's kind of a blip in the road. So down there you see the 2030 targets, quite ambitious, but stuff that we have achieved in the past and that we will achieve again. Let's move on. So here you see an overlook of all the various investments that are going on. So Wacker is really working on reducing the bottlenecks in its system so that we can further support growth. We're further focusing on the specialties part of the silicones business with a new facility in Kalovivari and expanding our specialties presence in Zhangjiagang in China. We are among the biggest specialty silicone suppliers in China, if not the biggest. In polymers, we're debottlenecking and expanding VAE dispersions, basically because the unit is totally full. And a big thing is for us the mRNA Competence Center that we're building in biosolutions for the German Pandemic Preparedness Fund. That will be completed in the middle of this year. And then once it's done, we'll get a reservation fee from the government. And obviously, very important for our business, in polysilicon, we're doubling our semiconductor etching facilities. So that's going to be good for order by mid-25. Demand for a semi-poly product is very, very strong. We're actually today negotiating shipments beyond 2030 already. So we really need this material. This was the theme of our annual report, investing in future people, markets, molecules. Wacker is rapidly internationalizing. When we did the IPO in 2006, it was essentially a Bavarian operation. Now this has turned into an international operation with about more than a third of our employees already outside Germany. 22 technical centers globally, 27 global production sites. So in the markets, for the markets, that's how we operate. And basically with a strong specialties focus. I recommend having a look at the annual report if you're in for that kind of stuff. So let's look into the P&L. You see, I think this is the most important part here, the sales bridge on the top right. We had to digest over 1 billion euros in price declines. And Nearly 2/3 of that, on top of that, in volume and mix decreases. Prices in polysilicon just fell off a cliff by the middle of last year as new capacities came on stream in China. Specialty volumes in silicones pretty much disappeared after March. January, February, March had strong sales, and suddenly it was all gone. So FX only played a minor role, but this explains how we got from 8.2 billion euros in sales to 6.4. Now, if you move to the left and see the gross margin, you see that not only this, we struggle with these massive price decreases, but the gross margin is also lower because we were facing a massive inflation in raws. So all told, EBITDA margin at roughly half the level of the prior year, but a net income are close to a quarter. Earnings per share from 25 euros down to over 6. The dividend proposal stands at 3. It was 12. So let's move on. Those kind of disruptions in the P&L will probably dislodge a couple other companies, but Wacker is very solidly financed. We're sticking to our guns if it comes to M&A and those things, and getting money out of the CFO is quite a task. And you see the results here. High levels of liquidity, 1.4 billion in liquidity, or essentially covering 2 times our capex. Pension provisions essentially almost fully funded, and a significant release of working capital that supported our cash flow last year. So cash is a strong focus at Wacker, as is cost and efficiency. And I think this is quite a thing for us to have such a resilient, strong balance sheet so that we can weather storms like what we're currently experiencing. Move on. Largest business of all in our portfolio is the silicones business. You see the silicones business saw sales declining in 23. The EBITDA margin declined over proportionally. Why is that the case? That is the case because we had a couple of things that we had to struggle with. That is that with the demand for specialty silicones, which carry most of the profit, almost falling away, we were facing adverse mix effects. Prices on standards also came down significantly in the course of last year, which all led to lower utilization rates, so less fixed cost absorption, and we had trailing high raw material costs. Pretty much a perfect storm that hit us. Now, if we look into 24, and again, our base assumption is that economic environment doesn't really materially change throughout the year. You can have a different opinion, that's fine. For our guidance purposes, this is what we assume. So we expect sales at the level of 23, but with a mid-single-digit EBITDA margin, essentially slightly below what we reported in 23 or the average of the last 3 quarters. Sales in the region is essentially all at prior year level, which for Europe is quite an achievement. We expect volumes and specialties to recover, and ASPs, especially in standards, are definitely defined by the very low exit rates that we saw at the end of 23. Now, what we saw going into the results was that our performance in Q1 is improving. Order intake is significantly up. January saw a very strong order intake. February was a bit less, and March saw another strong wave of order intake. So that makes it difficult to triangulate going forward. So our outlook for the full year is still uncertain, but Q1 looks actually okay, pretty good actually. So let's move on. Polymers. Polymers, 2/3 of polymers is related to the construction industry. As you probably all have heard, construction activity, especially in Europe, is down. So are our sales. What's actually going sideways, or is pretty okay, is adhesives and paints. Throughout the last year, we saw falling raw material prices, and our prices were adjusting to those raws. So we were actually able, by slower declining our prices than the decrease of the raws, to expand our spread. And this is how we were able to generate a slightly higher EBITDA margin, although the overall volume base is lower. Now, for 24, we expect the same thing to continue. However, raws will find a bottom, and when they go up again, there will be a period when we see compressed or slightly negative spreads. So that will have an impact on margins for the year. Today, there is no clear sign of a pronounced demand recovery. Construction is still pretty much anemic. So let's move on. Biosolutions, clearly defined by growth. in the cost of growth. So slower, you see the results here in 23. The first quarter is going to be difficult there as well. But as they say, it's darkest before dawn, and we're almost there with finishing the mRNA facility. Then things are going to get significantly better in the second half of the year. Polysilicon, the decrease here reflects massive price decreases, also some volume declines that we had as we had to go do maintenance and had some production issues. For these complex operations, that is what happens. But a major thing for us were the headwinds from very high energy costs in Germany. Now, a potential for improvement going forward is continued solar price differentiation by origin. Our customers achieve like 3 times higher module prices for selling materials in the US. Not all material qualifies to go into the US. Our material does. So as we enable that additional value, we feel we should be rewarded for that. And as a result, prices for polysilicon for destined to support exports into the US are significantly higher than China domestic prices. About half of our volumes are still priced on China domestic prices. We are in negotiations with customers. Let's see where this goes. So you see here our outlook for 24. We expect volumes as our operations pick up again to increase above prior year levels. But the average solar ASP, same issue as before with exit rates, is going to be lower this year than last year. You see we have a pretty wide range here. It's the same width of the range as we had last year. Last year we were indicating 300 to 500. Now we're indicating 200 to 400. The base assumption is that we will see improvements in volumes, mix, and price. Let's move on to others. This is a first that we have this in our annual reports. And the key issue here is that about 7-8 years ago, the German government instituted something that's called the Strompreiskompensation, which is essentially a compensation for internationally competitive energy-intensive companies for the embedded CO2 cost in the power that we buy. So this we get this back with a delay of 2 years. Now, 2 years ago, the gas prices were off the charts, and as a result, CO2 prices were very high. So it makes a meaningful difference. In the past, you barely saw this. But it means that we get a significant amount of money at the end of the year. Last year, this amounted to over 100 million euros. This year, it's going to be significantly higher. So probably 150 to 200. But in order to show that our segments and show them with a true and fair view, we credit this pro rata to the segments as they consume power during the year. Now, the money doesn't get paid automatically. It always needs to have a government approval on this, so you can't book it as you go. So we have to wait for that approval and then book it in the fourth quarter, which means that every quarter sees an offset of this credit in others. So we report the segments as if that didn't happen, and then the offset is in others, and in the fourth quarter, that's rollback. So if you look at the year, at the full year, and compare the years, there's no distortion there whatsoever. So because this created some confusion with analysts on how to forecast or model the other segment, you'll find some detailed guidance here. Now let's look. I spoke about cash and our massive cash conversion. Be higher than 1 already when we began this discussion here. So you see, this is where our debt is. I think that's a pretty solid financial position for a company our size in the market environment that we're currently in. So let's look at Q1. As I said, silicones is performing slightly better than originally expected or initially expected. We have improved order intake so far. As I said, January strong, February weak, March strong, so not really a uniform picture. But we expect sales and EBITDA in Q1 sequentially higher than in Q4. Now we have a large planned turnaround underway for Q2, and that throws some shadows over Q1, but the bulk of the expense is going to hit us in Q2. Looking at polymers, there's some seasonal benefits in Q1 from some construction activity. but it's significantly slower than it was last year. But we also see here sales and EBITDA higher than last year. Biosolutions still burdened by upfront costs, so that's going to be around the break-even level, probably. Again, once the facility that cost us so much and those unassumed or uncovered fixed costs at this time, once that's built and commissioned, it should make a significant difference on results in the segment in the second half. And in polysilicon, we're actually benefiting in the first quarter from lower energy costs. Sales are kind of at the same level as in Q4, but EBITDA is going to be higher than in Q4. So all in all, that means we end up with about 1.5 billion euros in sales in Q1, with an EBITDA at about the level of Q4. This was a run through our full year results. Interesting times. It's going to be interesting what happens in the first quarter. There are a number of open questions, a lot of potential. I think what's important is to see that we continue to invest in an adverse environment because we are convinced about our capabilities, our competitive position, and about our strengths. With that, if you have any additional questions, you can find us here. Thank you for your interest.